welcome again to the new day and new topic. And for us also to take a quick break from what we are doing for today. Thank you so much for joining us again and attending our webinar from any part of the world and through our live platforms, which Facebook and YouTube. Thank you so much for supporting Let Us Talk It. And today we are here to offer you two new topics again. As they said, learning continues, and learning is a form of investment for ourselves. And we have two great speakers for today who will give us the knowledge about these topics, but not just the topic alone, along with their experience as well. And the first topic for today will be the post pandemic view of leadership. Of course, a group of people or even professionals cannot go like a great trend like up or any progress without one leading them into creating strategies, like creative decisions and all that. And by leadership, we have here Marwan Abdin, who is a leader himself, who'll be giving discussion with this topic along with his experience through leadership. As Marwan is CEO and a leadership expert at ACG, which is Abdin's consultancy group, has worked as an HR and management consultant to government, local and international organizations over the past 15 years. He is a renowned strategic leader, a leadership expert working as the European Union consultant overlooking the leadership development of the Egyptian Ministry of Foreign Trade and Industry, the Ministry of Renewable Energy and Electricity, as well as several private entities. And here with his topic, yeah, he will be giving us all the informations we need and the view of leadership. And here we offer you Marwan Abdin. You can take over.
Thank you very much, Phil, for the introduction, and thank you for having me here. And it's a pleasure focusing on one of my favorite topics, which is leadership. Good morning, good evening, and for everybody watching from around the globe. Let's dive a little bit deeper into the post-pandemic view of the leadership evolution, because everything has changed and evolved over the past 3 years. And of course, a core thing that every organization and every expert, professional, manager, director, founder, an entrepreneur, or a CEO is indeed part and parcel of the leadership evolution itself. And being aware of how the evolution of leadership has come to is something that is very important for us to realize. What is the gap? Where are we so far? What are the competencies and challenges that are facing us so far, so that we can actually survive and thrive over the coming period of time with, of course, the post-COVID-19, the economic crisis, the wars, of course, and some conflicts is taking place around the globe. So everything has an impact and a sustainable effect on the businesses that we run. So let's take a look together about what are these challenges, what are the competencies that we need to work on, and what is the model that we can follow and work on and integrate, and then have some self introspect and self analysis of where we are and what we need to do. Okay, so let's take a little bit some facts to consider. So post-pandemic facts to consider. First one, of course, is that the world is experiencing an unprecedented era of volatile changes that has challenged leaders to step up and take new responsibilities. The levels of which that every leader in their own position have increased. So the responsibilities are not just the everyday habits and everyday tasks that managers used to have. And now we have to step up to new responsibilities that we need to work on. It's a reality, and we need to face the reality as much as possible. And with the significant changes that have impacted workplaces and the global businesses environment, leadership is even more important today than it has been in the past. And there is no doubt, working with CEOs and owners of companies across different industries, post-COVID-19 and with the crises that we are facing right now, the leadership part is a must. And if we're not working on developing the capacities of our leaders and our managers across the organizations, then we have a big gap that we need to fill. Other fact is that leadership is the critical lever in delivering the results organizations promise to external stakeholders, and good leaders inspire higher employee engagement. They ensure customers have great experiences that are consistent with the firm's brand promises. And they're on the front lines of creating internal and external stakeholder value. And they ensure the growth and attractive financial returns for investors. Great leaders, however, of course, lead in a way that demonstrates awareness of the organization's social responsibility and community and customer expectations. And because leadership matters, because it determines how organizations deliver on customer, investor, strategy, and employee expectations. Of course, all of these are stuff that we are already familiar with and have to put into consideration that there are more necessity and more highlight on each and every aspect of it. And this is where the gap is, despite the fact that billions of dollars are being spent on capacity building and training, developing and learning journeys for leaders across all sectors and across all levels. Still, leading organizations, they say that they spend over $160 billion on employee training and education. And that's only in the US, and that's the statistics to 2021. However, the same study showed that only 10% of CEOs believe that the company's leadership and development initiatives have a clear business impact, and that 77% of organizations report that they are currently experiencing a leadership gap, which again shows that despite the fact that, yes, there is a lot of money being channeled into training and developing and coaching leaders, still there is a big gap from the perspective of CEOs when asked about the initiatives that are being taking place. And that leads us to why is that happening? Maybe it's because of the changes that are taking place so violently around us, the changes and the ambiguity of what's coming tomorrow, what's coming next. So let's take a look about the challenges, which might explain why the gap is getting bigger and not smaller. Yeah, so with the pandemic aftermath, we need to check both sides. What happened to the businesses and what is happening with the workforce? Because of course the pandemic had its impact on both aspects, which of course are intertwined in the end. So when we take a look at the businesses itself, and we're taking some snapshots from different sectors. So businesses, of course, had to scramble to install or adapt new technologies under intense pressure. Of course, digitization and going digital was one of the main aspects and one of the main resources of surviving for companies. If you are not on the digital landscape, you do not exist. So a lot of new digitization methods, adapting new systems, upgrading their own servers, and it was done in some sort of a rush. So some of them, they actually made the wrong moves. They did the wrong setup for their businesses, or they optimized in a different manner than it should have been done. There is a move from reacting to the crisis now and building and institutionalizing what has been done well so far. So you have already built a lot, but it still hasn't become part of the culture of the organization. So now there is a backlog of initiatives that are yet to be absorbed into the culture of the company and yet to be fragmented or fermented actually into the weaving culture of the employees so that they can actually apply it across their change management initiatives. For consumer industries, again, for example, and particularly for retail, which is one of the sectors I'm dealing with, it could mean improving digital and omnichannel businesses and models. And again, there would be some sort of resistance going from the normal channels of wholesale and retail and actually merging them into one omni-channel platform. So again, a lot of resistances taking place from different sectors. For healthcare, again, of course, it's about establishing virtual options as a norm. So trying to going digital via AR, VR, AI integration, like chatbots, replying automatically to customer patients who are asking for certain illnesses or wanting a certain diagnosis. So again, a lot of aspects are changing in all kinds of businesses. Insurance companies, about personalizing the customer experience and so on and so forth. So how does it look for the workforce? So what is the aftermath on the working talents? The people themselves are expected to work and put in their efforts and try to go through everyday challenges within the new scope that their companies are developing. So first one, and of course it's one of the rising challenges for leaders, is the increase in remote working. So of course, the remote working was there and existent before 2019. However, after 2019, more companies are going more digital. A lot of companies like Airbnb, for example, is giving the freedom for employees that they don't have to return to office now that things are getting back to normal. So the way leaders are interpreting remote working can be either negative or positive depending on the culture of the company. So very important to put into consideration that 48% of employees will likely work remotely at least part of the time after COVID-19 versus 30% before the pandemic. So you can see the increase of people who are likely to work remotely, which explains why if you do not change in the policies, if you do not adapt to the new working methods, like blended work contracts, contingent working contracts. So the move from the full-time concept is something that is at hand right now. As organizations shift to more work, to more remote work operations, so we need to explore these critical competencies that employees will need to collaborate digitally and be prepared to adjust to employee experience strategies, which is again something that HR leaders, of course, are taking on their shoulders at the moment. Again, number two, with what is impacting the workforce is the expanded data collection. So leaders now, they have an increase in using non-traditional employee monitoring tools, because after you've been working with the remote environment, so we need to have some sort of insight about how our talents are doing. So I cannot see them anymore. You might be managing people in the same country remotely or cross regionally as well, across geographically. So how do we monitor the performance? How do we track our employees? How do we make sure that we're getting the best efficiencies out of them? All of these are current challenges post-pandemic. HR trends, of course, will be accelerated by new monitoring techniques of remote workers, the collection of employee health and safety data, for example, among other analytical tools, which is why data visualization, HR analytics, and all of these stuff are important parts to take into consideration. 16% of employers are now using technologies more frequently to monitor their employees through message, such as virtual clocking in and out to track attendance per se, tracking work computer usage, monitoring employee emails or internal communications and chat. So all these are stuff that are under, of course, the data collection expansion. Again, expanded employer role as social safety net. Now the role of the employer is not just the bread, providing kind of place. It also has expanded its mechanism and the concept itself into the employees' mentality. So the pandemic has increased the trend of employers playing an expanded role in their employees' financial, physical, and mental well-being, which is why there is a lot of stress in making sure that us as leaders are fostering a proper positive cultures for employees so that they can thrive. Because if we do not handle or tackle the impact of COVID-19 and financial crisis on our employees' mental well-being, then it will not be a sustainable relationship between the leader and their employees and their teams. So of course, supports includes enhanced sick leave, financial assistance, adjusted hours of operation, and childcare provisions. All of these have got to be put into the agenda of leaders. The current economic crisis also has pushed the bounds and the boundaries of how employees view the employee experience. Personal factors rather than external factors take precedence over what matters for organizations and employees alike, which again is something that we cannot ignore. Emergence of new top-tier employers, and this is the players who know how to play the game quickly, and this is very important. So a lot of employees and prospective candidates, when they're applying for a company, they now judge the organizations by the way in which they treat their employees during the pandemic. So it could have been a stigma for some companies, how they made, for example, the quick layoffs, or how they were a little bit ruthless with their employees when it came to the policies of attendance and leave and so on and so forth. So there is a lot of employer branding taking place now. The stronger the employer branding initiatives that are being taken in order to make sure that you are attracting the right talent and reassuring the talents that they will find a place in which they have safety and not just financial safety. CEOs and executive leaders here should make a lot of decisions, of course, regarding executive pay cuts, because of course we know the pay gap that sometimes can be existent in some organizations. So these decisions are being taken in a lot of companies. Still, we advise the CEOs and the company owners whom we coach on strategy to make sure that the pay gap is a little bit less, so that the bigger database of employers, or the broader base, can benefit from lesser cuts in their salaries, of course, or more benefits like mental health care and so forth and so forth and so forth. And again, one of the impacts on the workforce is the transition from designing for efficiency to designing for resilience. One of the key points that we need to focus on is that before the pandemic, it was all about how to make operations more efficient, regardless of the impact on the workforce or the talent that is working. Now we need to provide employees with varied, adaptive, and flexible roles, so they acquire cross-functional knowledge and training. So it's no longer about having a fixed job description or a fixed competency model. All of these are being updated, and even the word itself, the talent management in HR, has evolved into people management, because you're dealing with people after all, and you need to make sure that all the initiatives are targeted towards those people. Diversity leaders will need to be involved in role design and creation of flexible hours and work systems to ensure that employees of all backgrounds and needs are considered when the organization designs new workflows. So again, people are being put into the consideration and put in the balance while working on the new workflows post-pandemic. Contingent worker expansion, again, it's a result and a direct consequence of all of what we have mentioned above, as 32% of organizations, and this is according to Gartner, are replacing full-time employees with contingent workers as a cost-saving measure. So while the gig workers offer employers greater workforce management and flexibility, HR leaders will need to evaluate how performance management systems apply to these workers and determine whether they will be eligible for the same benefits as their full-time peers. Because again, you have to have, since you are having a diverse workforce, diversity in the workforce, you need to have, again, a fair system of performance. Even performance appraisal now has changed into different aspects as well. And again, quoting from the rebel groups, of course, with the David Ulrich and Norm Smallworth and Joe Hansen, one of the very good infographics that shows how leaders are involved in internal and external stakeholders' value. It can be intimidating, because this is actually how it looks like for leaders who are playing their roles properly. So you're actually responsible for the internal and the external stakeholder value. It's up to, of course, leaders across their different positions and different levels, whether it is handling your employees or organizations, or creating value for your partners, the communities in which you live, working with investors and owners and making sure that they put their trust and further invest within the company. And of course, the main one of the main pillars, which is the customers, making sure that the customer shares are increasing, and we're connecting with the customers and making sure that we know what they need and how their needs have evolved and changed post-pandemic. All of these, again, are some of the main pillars that leaders are held accountable for and responsible for. And if you look at it from that paramount view, it can be a little bit intimidating, of course, because you have a lot to work for, a lot of value to create, whether internal and external, which brings about, of course, the next model, and which is again quoted from David Ulrich, who is not just the founder or the father of HR, but also has a lot of great work in the field of leadership. And one of the very models that I depend on when training or coaching CEOs and leaders is the leadership code. And we're going to share like the updates that were recently put in that model. So basically you have 4 corners, and these 4 corners need to be put into consideration for every leader to be able to deal with the previous challenges that we have spoken about. We need to make sure where are our strengths and where are the areas of development that we need to work on. So if we look at the first thing at the bottom right of the screen, you'll see that you have the operational side, which is the strategic and the executor. And on the left side, you have everything that has to do with the individual, which is the human capital developer and the talent manager. These are the 4 domains, and we have a 5th one in the middle, which is the personal proficiency. But if we look at the 2 pillars on both sides, you'll find that usually not all leaders are very strong at all 4. Usually you're very strong at 1 or 2 domains. So two at best sometimes, and that has to do with your personal preferences, because sometimes people who are a little bit introverted or do not like to work directly or interact or confront people, they would usually like slip away towards the operational side. So they might be either good strategists, good executors, or both. And some people might be very good at dealing with people. They love to handle the challenges, to resolve the challenges of their teams. But when it comes to tasks, when it comes to projects, they're not that good at follow-up and supervising the execution of these tasks. So basically, they have a personal preference to dealing with people alone. And of course, that is not usually enough in all cases, because you need to have some sort of a variety of balances between the four domains. And of course, it depends on your position and the responsibilities that you have. And the more you develop yourself and the more you are aware where exactly in these four domains you're very strong at, keep using these strengths, capitalize on these strengths, but at the same time, don't turn a blind eye to the areas of development from the other four pillars. Make sure that you understand where exactly do you fall. So a quick, just a quick explanation to each of these pillars. So the first one, of course, is the strategist, and it all has to do with shaping the future. So where are we going? This is one of the questions, if you are a strategist, you'll be asking yourself. Not only envision, but can also create a future. So it's not just people might think of a strategist as that they just have a nice vision and they draw it on the board and tell the team, okay, guys, this is the vision. No, they actually create the future. It's not just about the vision. So they work with others to uncover how to get from the present to the desired future. And they work through ambiguity. And this is the updates on the model. So that I can actually be able to envision a proper future within the current circumstances after talking about all of these challenges and the gaps. So you need to be able to maneuver through ambiguity. And to do so, you need to be able to share data and to be very transparent on challenges and requirements for change with your teams. You need to make decisions in short term, act and react quickly, because sometimes some strategists, if they do not find easiness in working in the ambiguous, they might have something which is called the analysis paralysis. So they will not be able to make quick decisions, and this is something that is very negatively impacting on the business. Manage the process of decision making and make sure whom to involve in this process. Be clear about the criteria for decisions, particularly outside in. So working from outside and in, of course, using models of strategic management, such as the SWOT analysis and a lot of other tools that, of course, can be covered in other topics or talks. Frame actions and experiments as pilots, of course. You need to make sure that you are framing these actions and you are experimenting with pilots, not just giving theoretical visions in that sense. So getting back to from the strategist to the executor, you'll find that the executor is the one who makes things happen. So turning what they know into what they do. And this is something that is the core of what makes an executor. So being able to work with operations, and usually they will ask themselves, how will we make sure we get to where we need to go? And they would actually translate the strategy into actionable items. And they know how to make that positive change. They make decisions and create accountability. And in order to be able to maneuver with the updates, of course, that have been put in the model, is that they work through others to get things done. And they have the technical expertise to get things done right. And of course, they provide guidance to make sure that they help improve the decision-making process so as to be able to deliver results. And finally, you cannot do all that as an executor without providing the right culture. And again, right culture is something that is always being updated, that is always evolving within every organization according to its unique identity and needs. Getting back to the other half of the pillar, which is engaging today's talents as a talent manager or a people manager. So leaders who are talent managers know how to identify, build, and engage talent to get results now. Talent managers generate intense personal, professional, and organizational loyalty and help people develop themselves for the good of the organization, while making sure that you are providing a personalized experience for your employees and personalizing the work relationships between the team and between yourself and the team, which is very important. The human element is something that is a must, is a necessity. And finally, managing the mental health of the employee experience. And again, this is a topic that there is no doubt that everyone should be working on now if they want to thrive and flourish, if they want to make sure that they are hiring and retaining healthy employees across their organizations. And finally, and this is the maturity or the succession of the talent management, which is the human capital developer and building for the next generation. So again, having a foresight and having the ability as a leader to ask yourself who stays and sustains the organization for the next generation. And being a human capital developer helped the future leaders succeed. So it's about giving, the mantle to the next generation, but doing it on proper basis, strategic development plans, and making sure that the learning journey and development journey of your high potentials and your employees are done properly. That means that you need to be understanding how to develop the potential talent and helping the employees see their future careers within the company, because it's very important for us as leaders across organizations. And I'm not just specifically talking to HR leaders, but also to every people manager. So every people manager is responsible for retaining their employees, because in the end, it's people working for people. People don't work for companies, they actually work for people. So when they leave, it's because of something that happened in the relationship, usually between the employee and the manager. So empower others to build their brand, because again, the survival of companies now depends on how their employees are adapting and how they are integrating within the cultures in a proper manner. But that doesn't mean that you are fully digesting your employees. You actually want to empower them to become brand ambassadors. So sometimes some employers would fear that, okay, I have an employee or a manager who is doing some talks or putting some infomercials or stuff on LinkedIn, for example. And they would tell me, no, don't do so. Don't do so. Of course, unless there is a conflict of interest. However, encouraging the employees to find their own personal brands, this will actually add to the employer brand, and this will actually add to the employer's reputation itself. So not being afraid to empower others and helping them in self-branding of themselves, they actually in which they're working. And of course, this means building long-term relationships with the employees. And again, getting back to the full model. So as you can see, you have the 4 pillars, and right in the middle, and this is your task as a leader, to understand where exactly do you stand in the 4 pillars and work on the personal proficiency. And this comes when you invest in yourself in the right manner. So making sure that you're seeking the right learning, you're actually analyzing yourself, being self-aware of the areas, find a coach, find a mentor, find someone in the company or a colleague or a peer to give each other 360 feedback or exchange feedback. Make sure you always are up to date and you're always aware of where the current market is going and what's happening around you. Making sure that you're actually updating yourself when it comes to technology. Making sure that you are not stuck in the comfort zone and you're actually seeking and being proactive in your self-development as a leader, so that you have an accountability and responsibility to your organization and to the teams with which you're interacting, and of course to the different stakeholders that we mentioned, which are internal and external. And that sums up our talk for today. Hopefully you take this message and reflect on what you need to work on, whether as a strategist, an executor, human talent manager, or human capital development. What are the personal proficiencies that you need to work on in 2022 so that you can lead yourself, your organization, and your teams to success? Thank you very much.
Thank you so much, Marwan. That's really a great discussion that you have shared, especially the 4 pillars. Why not a leader can have all 4, just 1 or 2?
No, usually you can adapt from the different 4 domains, but it needs a lot of work. But the natural inclination is usually to 1 or 2. However, of course, you can try to work and develop the other pillars as well.
That is perfect. Well, again, thank you so much. And we'd like also to recognize the CEO, Srini, we have on the panel list, and we have attendees, Balakrishnan, Raviward, Satya, Shankar, and Top Shelf Equity. If you wish to ask a question to Marwan regarding the topic, please feel free to unmute or put it on chat, or just insights, additional details.
Yeah, Marvin, I have a question. This is Ravi.
Hi, Ravi.
Yeah, for organization which needs your support, how do you intervene? What services, and what are the steps you take to, take it to the next level?
Yeah, usually it has to be an open discussion, of course, with the CEOs and the stakeholders and C-suite levels. And of course, we speak with all directors across the organizations and key players to make sure that we understand what is going on, because of, again, approaching each and every company, we need to respect their uniqueness, and that every company has its own characteristics and its own nature. So listening a lot at first, so asking a lot of questions so that we can derive what needs to be done, and then we decide in a mutual manner on what needs to take place after conducting the proper organization and assessments as well.
Thank you, Marvin.
You're most welcome.
Yes, Marwan. It's a great presentation. I think it's a good bird's eye view or view of all the things and the most important things. And some may not, seem to have tangible impact immediately, but very, very important ones. So would definitely love to know more about any specific case studies that you have done, and you can feel free to email to Phil and team, and we can talk more based on those. Any specific case studies are for the customers that you dealt with, and how it improved various aspects of productivity and the others.
Sure,
Thanks.
it'll be my pleasure, of course. Thank you very much.
Thank you very much. And if you wish to know more or get more from Marwan, feel free to send him a message or contact him through LinkedIn. Just type his name and he'll respond just about the right time. All right, that's perfect. So we can move on.
The same spelling. Thank you.
Yeah. Thank you so much, Marwan. So we will move now to the next topic for today. And well, of course, you cannot just sit alone and work with just one job. So of course you have to make investments, and also there was a saying that you have to make your money work for you, or else you will have to work for your money. And here the next topic will be navigating the current investment trends, and this will be given to us by Milan Vaishnav. He is the founder of Chart Wizard, FZE, and Gemstone Equity Research and Advisory Services. He's also the author of one of India's most accurate India-focused daily or weekly market outlook, a daily or weekly newsletter, currently in its 18th year of publication. It's very, very long years of publication that has been done. So many efforts and all of the knowledge and experience has been there. And with this topic, the most qualified to give us the information for the trends of investment will be Milan. And please take over.
Yes, Phil. Many thanks for the wonderful introduction. And I welcome everyone who have joined us here. And in fact, thank you to LetUsTalkIt for having me on this platform. The reason for going on for this topic is that regardless of the professions that we are all in on respective basis, investments is something that we have to do, we have to deal with. And as such, we really do not have the option of not dealing with one. And if we take a realistic view of what is going on in the financial markets, well, whether it's the Indian markets or the global markets or US in particular, things have not been so kind, especially in 2022. So in this short talk, we'll take a look at the general trends which are prevailing in the financial markets, and how should we navigate the current volatile trends. This entire talk may sound a little technical, or at least the visuals may appear a little technical in nature, because I'll be walking you through all with few of the charts. But I'll try and keep it as much simple as I can, so that it can be of some practical use after the show is over. In this session, we'll try and take a general look on the US as well as the Indian financial markets. We'll take a glance on the other asset class as well. I mean, the investment instruments like gold and oil. We'll also take a look at the cryptocurrency as an investment instrument. We'll take a look on how these asset classes have performed in 2022. And what can be the potential investment areas going ahead in 2022 in the following months to come. We will review some very basic investment rules that we all need to follow, regardless of which stage of life or profession or career we are in. And as Marvin just explained, that how investing in yourself help, we'll also take a look on that with the perspective towards financial markets. So before we deeper into anything else, let's take a view on the key global indexes and the commodities that have performed so far in year 2022. What you see on screen is the relative comparison of key indexes like Nifty 50, Nifty 500 from India, S&P 500, the broad-based US index, NASDAQ, and two cryptocurrencies as well. Now it's a little interesting, disheartening both to see that only these two instruments. Let me try and just give me a moment, please. Well, I'm not able to take the pointer out from here, but it's okay. As per this relative comparison chart, we see that only the crude oil has returned a massive positive return of 41.72% in 2022. After that, gold is not in the negative, but it is just flat at around less than 1% of return on YTD basis. Now, if we see that rest of all the indexes, be it Nifty 500, the Indian broad-based index, Nifty 50, which is the Indian frontline index, S&P 500, the US broad-based index, NASDAQ, all have returned negative returns ranging from minus 7.5% to as big as minus 24%. It is NASDAQ which has performed the worst in this year. Even worse are the two cryptos, Bitcoin and Ethereum, who have returned minus 36% and minus 44% on YTD basis. So things have not been so pretty so far. And taking a singular look on the figure, it sends us a scary message when it comes to global equities. However, there are a few technical things that we need to take a look on. This is the last 3 to 4 years chart of S&P 500. It gives us a message that we are primarily not in a downtrend. The downtrend has not begun. What we are seeing is a retracement from the peak. The peaks that were witnessed in October 2021, markets are just showing a corrective move, and the primary uptrend continues to remain intact so far as S&P 500 is concerned. If I can just show you on the chart, the price is above the 2 of the 3 key moving averages. And so long as it stays above this level, which is 3480, so we can take it as a round figure of 3500. So long as SPX is above 3500, what all that we have seen so far will remain a secondary market correction and just a secondary trend, with the primary trend being intact. Same is the case with Nifty 50. Ideally, I should have compared it with Nifty 500, which is the counterpart of the broad-based S&P 500. But the reason I'm taking Nifty 50 is that more or less the correlation remains pretty much same. So just for the sake of convenience and more comfort when it comes to talking about Nifty 50, I'm comparing it Nifty 50. Nifty 50 has been a gross outperformer as compared to S&P 500. It also remains in a primary uptrend. If you just see that after the peaks that were witnessed in October 2021, the markets have just corrected in a falling channel, and it has just been in a secondary trend, which we call a corrective trend in the bull market. And the primary uptrend continues to remain intact and very much in place. Moving on, we would also like to take a view on gold and the crude oil. These are, in fact, the only two commodities we have which have returned a positive returns in 2022 on YTD basis. Gold has just managed to stay in the positive by just some 1% gain as of yesterday's close, whereas crude have given massive gains, as we all know. If we take a look on the technical structure of gold, it has got a key resistance area between $2,000 and $2,070, and that's where exactly a classical double top has come into play, and that is exactly where we saw the precious metal seeing a sharp corrective move the moment it went above 2,000. But however, at the same time, we also need to see that it is right now resting at multi-month support. So long as gold stays above 1750, we will see it being bought with every dip, and the overall bias remains on the positive side. Same is the case with crude. Unfortunately, I would call, because a sharp rise in the crude will obviously have its cascading effects among all sectors of the economy. We will see the countries affected by inflationary by inflation pressures that we all are having, regardless of we being in the US or in India. But after its sharp move, by the way, crude is plotted on this left axis. So after it marked its most recent high, it is consolidating in a wide range. And there are all chances that this continuation pattern, which we call it a symmetrical triangle from a technical perspective, might end up acting as a continuation pattern. And so long as gold stays above $95, it has got all the possibilities to inch higher. Then let us move on to rest of the two asset classes, the highly volatile of them all, that is Bitcoin and Ethereum. The I'll call it the top two traded cryptos in terms of they being mined, in terms of they being issued. They have been the worst performance, worse than equities, because basically Bitcoins, basically the cryptocurrencies tend to give good performance when there is a risk-on environment in the markets. So when we say risk-on, it is basically, by risk-on, it means that when one shows a bigger preference for riskier assets, it is said that a risk-on approach is being followed. So when there is in fact a flight for safety, when the interest rates are rising, when people are flocking towards safer investments, obviously equities will take a back seat, and even more the cryptos will get affected in a negative way. So they tend to remain in sync with the equities, and but being more volatile in returns, they tend to perform worse when it comes to the performance on the downside. But again, the cryptos, both of them, Bitcoin and Ethereum, are right now at their multi-month support, and it would be quite crucial to see if Bitcoin is able to hold the 26,000 level and Ethereum is able to hold 2,200 levels. So long as these levels are held, we will see them oscillating in a wide trading range. moving on, the next what we saw until now was more of a kind of situational awareness kind of thing. We just tried to see where the markets are, whether the primary trend is intact or whether the primary trend is has ended and we are into a downtrend. All said and done, what we just had a look was a kind of situational awareness kind of thing. Now this something that you see on the chart. This is a different kind of chart, which is called relative rotation graph. It spots the sector rotation, and it also gives up some indications whether we are in a risk-on or risk-off environment. This, what you see on the screen are the spider sector ETFs, SPDR ETFs, as we all know it. They are plotted with S&P 500 as the benchmark. So this shows how different sectors are performing against S&P 500. And we see that some pockets like retail, communication, technology, and all are doing a little better. So what we see in the market is a mild risk-on approach, because we are seeing both of those sectors, which are sometimes it's the basket of sectors which are doing good is a mix, which is seen not always seen at one point, because it has a mix of those sectors which usually perform well in times of risk-on approach, and we also have some defensive sectors like consumer staples and consumers non-discretionary, which do well in the risk-off thing. But here we see that a mixed kind of basket is doing rounds in this market. So by and large, the overall stock market setup is a bit of defensive with a mild risk-on approach. And over the coming months, so far as US markets are concerned, we can expect retail, communication, consumer staples, materials, and technology doing better than the others. If we try and take a look at the similar setup in the Indian markets, here you see that different Indian sectors are plotted against the broader Nifty 500 index. And here also there are the sectors that we see here are mix of both worlds. We have certain sectors which usually do well in the risk-off, do well during risk-off times. And we also have a couple of sectors which may do well during risk-on times. This box has got mixed participants who are likely to do well in the remaining 2022. So examining the Indian markets, it continues to wear a defensive view, but there are still some tinge of risk-on approach still prevalent in the markets. So from the defensive pockets, we can see that we will see that FMCG, consumption, and these two pockets, IT is also a defensive stock when it comes to India because of the weaker rupee. Usually when the rupee gets weaker, IT companies tend to do well. So consumption, FMCG, and IT are those participants or are those sectors which are likely to do well in the remaining 2022. And apart from this, there are other sectors also which usually do well when there is a risk-on environment, are realty, autos, and financials. They are also expected to do well because they have been largely underperformed the broader markets, and their phase of underperformance might come to an end in a couple of weeks' time. So to sum up, if we sum up, the potential investment areas that we can look at for US markets are retail, communication, consumer staples, materials, and technology. And when it comes to India, we can see realty, consumption, FMCG, IT, financials, and select auto stocks doing well in the remaining part of 2022. So when it comes to our investment portfolios, if we have this good quality stocks from these sectors, we may do very good, and our portfolio can be quite resilient even during bad times. And we can have, we may not be having absolute outperformance every time, but we can certainly have a resilient relative outperformance against our benchmark, which is usually the broader markets. I mean, either it can be S&P 500 in case of the US, or Nifty 500 when it comes to India. Let us also revisit certain basics. When we say that we are trying to revisit the basics, I'm also trying to convey that during volatile times, during turbulent times, it always pays to stick to the basics. So regardless of your distribution of funds between equities and fixed income and commodities, investment in cryptocurrencies should ideally be not more than 10 to 12% of your total corpus. This is the most frequently asked questions that I keep getting from our clients, and on professional social networks and all that. That cryptos attract traders and investors alike because of their volatile nature, and I have often seen that people jump into trading the cryptos without knowing much about them, without having much control over their moves, and they end up exposing a considerable part of their total portfolio to cryptos. So that is something that we need to avoid. And keeping in view that rule, I would very strongly suggest that crypto should not be given more than 10 to 12% of exposure out of your total investable capital or the corpus. Coming back to the commodities have given phenomenal returns, and they have come to the limelight. They have been giving consistent returns, but nowadays they are more in the news because of the rise in food grains, in crude, and a potential up move that is impending in gold. So commodities should not and must not be neglected. And when it comes to having them in your portfolio, ideally investors can find it convenient to stay invested in the commodities using ETFs as a means of passive investing. It may not be possible for everyone to go out and buy futures and manage the technicalities of the trading and manage the margin exposure and mark to markets and everything. But if you are just a quiet investor and still want to stay invested, I believe ETFs are a best and the safest and easiest means to stay passively invested in the commodities. Now, moving on, it's a very famous rule that one would use to answer that how much exposure you must have into equity. The golden rule is that 100 minus your age should be the equity component of your portfolio. Now, if I explain this by an example, let's presume if you are 40 years old, then 100 minus 40 comes to 60. So 60% of your total investment must be in equities. That's the general rule, but I would have a slightly aggressive approach that if you are below 50, say for example, you should not mind getting little more aggressive when it comes to allocating money towards your equity investment, because even if you look at the historical data, I'm not talking about staying invested in the penny stocks or small caps or highly volatile or rather operator-driven stocks. Operator-driven stocks is a term that is used in India, but if I talk it in a general perspective, I'm not talking about those small caps and mid caps which have got a low floating stock. But if we stay invested in in blue chips, in good quality frontline companies, it is quite obvious, in fact, a matter of common sense, that equities have always outperformed the other asset class when it comes to longer term investing. So if you are below 50, 100 minus your age should be your equity. Should be your equity component in your portfolio. That's a rule of thumb. That is something minimum that you must do. But above that, if your age permits, if you are below 50, then I would even suggest getting little aggressive on the equity front. The another benefit that we can have as investors is to sticking to basics means having a focused approach is also a part of it. If I elaborate a bit more on that, avoid frequent trading. Many of us are lured by, nowadays, equity markets are much more in the news. We see technology stocks gaining so much in the end of 2021. They are losing equally fast in 2022. And we all get tempted to get involved in day-to-day trading. But I would suggest that have your steadfast focus on investing and avoid frequent trading unless you are professionally equipped to do so. Unless you are professionally equipped as a trader and know the ins and outs and the risks involved in trading, do not do it. Do it only if you are professionally equipped and if you are able to spend time before the screen, because it requires your full-time attention. Otherwise, stick to basics, stick to investing, that too on a regular basis. I would like to point out that trading produces profits, but investing in the long term produces wealth. So never forget this. Another thing that I have seen most people making mistakes about is they stop investing the moment the market start going down. We need to remember that regularity is the key for compounding returns. If we are investing something in like systematic investment plan or something like SIP, I have seen many people who stop investing the moment the market starts falling. In fact, they should be investing more, or at least they should not stop investing, because when you make investment in a falling market, you are buying each month at a lower price. And in fact, it is good for you in the long term. Real compounding effect in any SIP will come after third or the fifth year, depending upon how aggressive your stocks are or how low or high beta your stocks are. But in the first 3 to 4 years, it is very common for anyone to lose patience or to get disappointed when the market starts to retrace or correct. But I would very strongly suggest that just because the market are falling, one must not stop or one must not be irregular when it comes to making contributions to your monthly investment targets. In fact, you must continue to invest, and it is beneficial for your portfolio in the long run, which we'll see in the third or fourth year once you see the actual effect of the compounding taking place. Again, I have I have said it many times in many of my sessions that investing in yourself is perhaps the most or the best investment ever that you can make. So while you consult your financial advisor, that's something that you must always do. Do invest some time, some money for educating yourself. I also said that before you invest some money in the market, please invest some time. Get to know the basics, educate yourself, invest in yourself in learning basic about the fundamentals, basic about the technicals, because investing is something that requires at least a working knowledge. Investing is something that we will not be able to deal with, or rather avoid dealing with in our lives. So acquiring a working knowledge is a must. And I would very strongly suggest that rather than blindly following the media or blindly following the inputs that you find on the internet, that you find on the electronic media, that you find in the print media, you must have enough working knowledge to at least make sense of what you are doing. So invest in yourself, that will be perhaps the best investment you will ever make. So these are the something, what we discussed today was that we had a look at the situational awareness that we have in the markets, where our markets are. We came to know that we have just seen that the primary trend might have been disrupted, but it largely remained intact. We also shortlisted the sectors which, if at all we stay invested in, will lend high resilience to the portfolio. And we also revisited certain basics of investing, how we can navigate the volatile times, how we can avoid the feeling of panic when we see some corrections in the market. More knowledge-based our action will be, less panic will be there when it comes to reacting to the markets. So sticking to the basics helps. not only during good times, but more during such volatile and turbulent times. So this was something I wanted to convey through this. So if we have any questions, I would be more than happy to take it. Or else my contact details are displayed. As and when you have questions, you are most welcome to reach out to me, and I'll be replying back and attending them back in the best way that I can. Thank you. Phil, you may please take it over.
Yes, Milan, thank you so much for the wonderful session and for the very knowledgeable display of your visual. Thank you so much for that. And we have a question about when you started from Satya. First question Satya had, would Nifty break out from S&P trend?
See, S&P and Nifty have both enjoyed a positive correlation over the last 10, 15, 20 years. Look back, as much back as you can go. Nifty itself is not more than 20 years old. So they both are positively correlated. So Nifty breakout from the S&P trend, well, I don't understand this question clearly, but they both will tend to move in the same direction. Only the intensity of the direction may be less or more. For example, we both are moving downwards. S&P is moving downwards, Nifty is moving downwards, but the intensity of S&P moving downwards is much more than Nifty. So the directional consensus between two index will remain. Only the intensity may change a bit here or there. They have moved in tandem with being positively correlated in the past, and they will remain positively correlated in the future, except the degree of the correlation will vary a bit.
I hope that answers. And there's a follow-up for that. S&P index is beaten down relative to Nifty.
Yeah, exactly. That is what I say. See, there are two aspects to it. When we say the correlation, we see the direction of the trend. So when Nifty is going up, S&P usually goes up. When S&P comes down, Nifty usually comes out. So the correlation remains. Only the intensity of the correlation is slightly, changing every time. This time we are relatively performing better than S&P. If S&P has declared an X percentage, we have also declined, but to a lesser extent.
And Satya would like to know if crypto trading is legal in India, as there was confusion about it.
Crypto trading is not illegal in India. It is perfectly legal in India, but but it is not sovereign backed. So we do not have any regulatory control over the crypto trading. The only thing is that trading in crypto is subject to tax. Apart from that, if we have any kind of dispute with the exchange or the crypto exchange or crypto service provider, we don't have any regulator in place. So there is an absence of regulations. But there is certainly, it's not illegal. There is only absence of regulatory oversight.
And Satya said, thank you for all the responses you have provided. And we have Shankar, who wants to know your thoughts on XTN.
XTN, I see little positively correlated with the broader market. So I see it with a mildly and cautiously bullish bias. We have to be, we are positive on it, but very cautiously positive.
Okay, I hope that answers your question, Shankar. If you wish to add further, you can feel free to unmute. And our CEO, Srini, would like to thank you for your great insights. Milan, thank you so much.
It's my pleasure. Thank you so much.
Okay, and I guess that concludes. We have Ravi, yes?
Yeah, I wanted to thank Milan for the insights. This is pretty interesting. Very few people talk about investments. So this presentation was very insightful. Thank you, Milan.
Many thanks, Ravi. Thank you so much.
And Marwan, I'd like to thank you as well, Milan, for your insights, the same as the others. And we speakers, thank you so much. We are very pleased and to have you as our speakers for today with those very interesting topics and a very timely discussions. So appreciate your time and your effort, and also your knowledge with your experience being shared to us. And for those who have missed the session, you can always see this in our YouTube channel and also our Facebook page. And also, you can contact our speakers through LinkedIn, and or you can get in touch with LetUsTalkIt team to know and get more of them. And also, we'd like to let you know that we also have Let Us Talk It webinar for our youth. That happens every other Saturday at 4 p.m. Eastern Time. So there are preparation sessions Tuesday and Thursday at 4:30 p.m. Eastern Time. So you can register at our letustalkit.com/youth website. That's for our youth group. So it will encourage them and help them share knowledge as well in their age bracket. All right. So that concludes the webinar for today. Thank you so much, everyone, for joining us. And we hope to see you again next Wednesday, same time, and two new speakers and two new different topics to be discussed. And speakers, thank you so much for your time today again. And for everyone, have a safe evening, morning, or afternoon. You take care as always, and all the best.
Thank you, Phil. Thank you. Have a great day.